Life insurance can feel complicated. Whole life, term, IUL. How do you decide what's right for you? Each type serves a purpose, but they're not all created equal. Today, we're going to break down 4 common types of life insurance. Traditional whole life, often used for final expenses, term insurance with living benefits, dividend-paying whole life, which is the backbone of infinite banking, and indexed universal life, a flexible option with market-linked growth. And by the end, you'll understand how each works and the pros and cons which might fit your financial goals. The first is going to be just your traditional whole life insurance. So traditional whole life insurance, it's straightforward. There's a no-frills policy with a fixed death benefit and a small cash value component. It's often a final expense policy because it's commonly used to cover funeral costs, medical bills, or smaller debts. These types of policies, you pay the same amount every month or year, regardless of age or health conditions. It's a guaranteed death benefit, so your beneficiaries receive a predetermined amount when you pass. Some of the issues with these types of policies is, one, they have a very slow cash value growth. While there is a cash value, it grows very slowly and often it doesn't really do anything. So when I look at these policies and I meet with people, I typically don't recommend this type of policy for pretty much anybody unless they're a senior just looking to cover funerals. It's more so just to have in place so that nobody has to look for the money in the event if somebody passes. But for most scenarios, I don't recommend this just because with a fixed death benefit, if you live over the age that they determine you were supposed to pass, you end up paying more into the policy than you even put in the first place. This is the most common type of insurance that's actually sold when it comes to whole life, and that's what gives whole life a bad rap in the first place, because with these types of policies, if you pay in for a certain period of time, you've paid in more than what you're going to get on the back end. So this is the type of policy that Dave Ramsey is against, because the more you put into this policy, you don't get much more out of. So they can become a trap, especially for people who get stuck in these policies and they think that the policy is going to increase in value, but in reality, it just hits a ceiling and it never goes above that. So a lot of people end up in a tough scenario where they've been paying on a policy for the past 20, 30 years and their death benefit's the exact same, even though I've seen in some cases where people have paid twice of what the death benefit is in the policy. And that's just a tough one. For these types of policies, again, the only people that should look at this type of stuff would be people if you have serious pre-existing health conditions. Most normal health conditions or anything like that, you can still get other types of policies that do grow over time, and people that just want peace of mind, right? What's the peace of mind worth? A lot of people get coverage just for the peace of mind, and that's fine. That's a different purchase that we're looking at instead of trying to protect wealth or anything like that. We're really just looking to have peace of mind just to make sure that in the event if something does happen, that everything is taken care of. The next one on the permanent side is going to be dividend-paying whole life. Okay, this is a type of whole life insurance we use for infinite banking. So it provides lifelong coverage, it builds cash value, and pays dividends when issued by mutual insurance companies. So the first thing that we're looking for is going to be guaranteed cash value growth. The cash value grows is steady and it's not affected by market volatility. The dividends with mutual companies often pay annual dividends, which at that point we reinvest to grow your policy even faster. Another pro is you get liquidity. You can borrow against your cash value tax-free at any time by making this a flexible financial tool. This coverage is permanent, so it will last your entire life. So typically the people who use this type of coverage are individuals who want to create a personal banking system. Families looking to build more so generational wealth, especially when structured properly, and those seeking a safe tax-free way to grow their money. So cash value as it grows in the policy can be tax-free and accessed without penalties. Dividends enhance the policy's growth. So it provides liquidity for opportunities and emergencies, creating a lasting financial legacy with the death benefit as well. So some of the issues with these types of policies that a lot of people run into is they do have typically higher premiums when it comes to, say, a term product or an IUL, but they're looking at the product wrong. Because with this type of product, what we're doing is we're taking the least amount of insurance and putting the most in cash value. A lot of your money you end up seeing back within 3 to 5 years of the policy being in effect. So the money does get recaptured and you are able to see it, but it does take a lot longer for you to see that if you're looking for an immediate return. The second thing, this does require commitment and proper structuring to maximize the benefits. If you're just buying a policy off the shelf to do what you're looking for this to do, it's not going to work, because these policies have to be specially structured in order to do what we need them to do. And any product just off the shelf is not going to do it. It's going to lean more on the death benefit side. So dividend-paying whole life is ideal for those looking to combine protection with wealth building. The next is going to be term insurance with living benefits. So what is term insurance? Term insurance is temporary coverage that lasts for a specific period, like 10, 20, 30, sometimes 40, with living benefits, which is a newer feature that allows you to access a portion of that death benefit while you're still alive under certain conditions. So temporary coverage, you're covered for the term you choose. After that, the policy ends unless it's renewed. The living benefits, you can access funds if you're diagnosed with a chronic, critical, or terminal illness. Now, one of the downsides of a term product is there is no cash value. So unlike whole life insurance, term insurance doesn't build a savings vehicle. All you're doing is you're just paying for the amount of insurance. You're not paying for any of the cash value growth. So this product is going to be better for those who just want affordable coverage during their peak financial responsibilities, like raising kids or paying a mortgage, or individuals that are concerned about an unexpected health issue during the policy term. So some of the pros of term insurance is going to be, it's going to be the cheapest of them all. It's very affordable as compared to a permanent policy, and the living benefits just provide flexibility for medical emergencies, and high coverage amounts are easier to obtain for lower premiums. Some of the issues, there's no cash value or savings component, and the policy will expire at the end of the term. The cost of insurance can increase significantly if you do renew it later in life. Now, one of the things you can do when you do look at term coverage is always look for a policy that does offer a convertible term. What that means is at the end of the term, if you do want to keep it, the policy, they'll renew the policy as a permanent policy, and then you can use that policy as more of a permanent solution. This is the best of both worlds, and personally, I wouldn't get a term policy without it being able to be converted into a whole life, just so I do get the flexibility of changing that later instead of just flushing all the money down the toilet once I end that term. And then the final one is going to be an indexed universal life policy. So an indexed universal life policy technically offers flexible premiums and cash value growth that's going to be linked to the stock market, like the S&P 500. It's going to be a mix of insurance and investments, and it's designed for people who like looking at market-linked growth without direct exposure to the market. Now, this type of policy is probably one of the most misunderstood products, especially when it comes to the insurance space. So an IUL on paper is an annually renewable term. So what that means is every single year, that policy is going to renew, which means the cost of insurance goes up. With a term product, you're locking in your cost of insurance for 10, 15, 20, 30 years. With an IUL, it's going to renew every year. So what that means is later in life, your cost of insurance is going to go up. Now, the issue with this is while an IUL has a 0% floor, the cost of insurance eats directly into your cash value. So on paper, they can show that it does have a 0%, but in reality, if you do have a 0% year, the cost of insurance is actually going to make your policy go backwards. When it comes to the growth, there's caps and floors. So what that means is your policy has a cap, so you can only gain so much interest, and then it will have a floor, which is typically 0.25, sometimes 0% based on the market. So with this, what they're offering you is market protection as well as the ability to participate on the market ups. Now, the issue with this is in many scenarios, the cap rate can be adjusted by the insurance carrier. So if you're looking to use these types of policies for, say, infinite banking or even accessing the cash, especially when you're in retirement, it's not really recommended, only because when you do that, your cost of insurance goes up. When you're taking loans from these types of policies, it doesn't behave like a traditional whole life would if you're taking retirement income. With an IUL, when you do take that retirement income, you then have to take a loan against the policy, while with a whole life, you can just have the dividend pay you. So you don't have to worry about the policy lapsing. With an IUL, as you're taking those loans out, your cost of insurance is still going to continue to go up, which unfortunately will end up happening is most of those policies where you are taking retirement income from and things of that nature, the policy will end up lapsing. If you're looking at an IUL, a good way to look at it is if you just want to put your money in that and treat it more like a term that might make it to the end of your life, that's a good way to look at it. If you're not taking any money from it, you're not doing any income replacement, especially in retirement. If you're using an IUL for just the death benefit, you probably will be fine. But again, it more so depends on the market performance in order to achieve that. And with an IUL, that to me goes against what we're looking for, especially when we're looking at insurance. Insurance in no scenario should be treated as, say, an investment. In reality, it needs to be just a safeguard. So if we look at term, we're safeguarding in the event if something happens to us that there's a large amount paid. So we're paying for a large amount of insurance, but we're not paying for any cash value. With a traditional whole life that pays dividends, what we're looking to do, we're looking for a safe place to put our capital to then either be able to use our capital or just put our money in a safe spot where we know we're going to get some dividends and some growth while that money's sitting there, giving us market protection in the first place. With an IUL, there's no real guarantees on that policy has to make it all the way through your whole life. So the insurance carrier isn't in as much risk as the consumer. So typically an IUL is going to actually be more risk on the person rather than the insurance carrier, which can become an issue when it comes to utilizing these policies for what they're marketed for. Do they have a place? Yes, but most of the time they're actually mismarketed to try and do something that they're not actually able to do. So who's this product for? I'd kind of touched on this prior. An IUL, if you're really just looking for something to pay, have a good amount of coverage, and then, if you don't really need the death benefit, then that's kind of the best spot. I don't really know a good spot where an IUL really works for what we need it to, as opposed to, say, getting a term and then just converting it to a whole life and having that death benefit. That's going to be a better way to look at it if you need a larger amount of insurance. If you're looking at it for infinite banking, it just doesn't work because the cost of insurance, it's not going to work out. You wouldn't go to a bank and then the older you get, they say, hey, it costs you more money every year to put your money in this bank, right? If we're looking at it for an infinite banking scenario, that's not what we want to do, because the purpose of the infinite bank is to safeguard our money and keep it there with fixed expenses, or just in a way where we can utilize that money. An IUL doesn't guarantee that, even though you're probably shown some stuff if you're looking at illustrations. Most of the time, it's not going to give you what it actually is. And the insurance carrier, they're not required to actually pay you those cap rates. They can illustrate them, but they're not required to keep those in place. So here's a quick rundown of what we covered. So traditional whole life great for final expenses, but very limited in the flexibility or growth. The next is going to be term with living benefits. It's going to be affordable and practical for temporary needs, but you're not going to get that savings component that some people want. Dividend-paying whole life is going to be ideal for infinite banking, offering lifelong coverage, as well as cash value growth and liquidity. An IUL is really just going to be a good option if you're more so on the term side and you want to just have something in place. That's a good way to put it. When it comes to income or anything like that in retirement, I just wouldn't recommend an IUL for that. Choosing the right insurance depends on your financial goals, stage in life, and what you value the most, right? Whether it's affordability, flexibility, or wealth building. If you have questions about which policy fits your needs, drop a comment below or reach out to me directly. Don't forget to like, subscribe, and share this videos with others to help them understand these types of products better. Thanks for watching, and I'll see you on the next one.